Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
All right. Hi, and welcome to the second installment of this podcast series on annuities cutting through the crap. Today, we're going to explore different methods of receiving income in retirement. And we're going to call this one income the Wall Street way, the bank's way, or the insurance company's way. Because when you really think about it, when you saved all this money outside of Social Security and pensions, you've saved money all this time in 401ks, 403bs, and when it comes time to retire, how are you going to get income out of those? And so we're going to look at all the different areas that most people are going to go to in order to get income in retirement. And we're talking about the mailbox type of income, the income that you really don't have to work for, the passive income, the retirement income. We're excluding real estate from this discussion right now because real estate's not necessarily retirement income. It's more like a job. A lot of the people that I know that have real estate, you're either managing the property management company or you're managing the property yourself. And so it is like a job. So we're going to exclude that, which, if you think about it, though, that could actually give you income in retirement, but it's not really income from investments. It's income from real estate. And like I said, it's more of a job rather than passive income. So what we're going to do here, in order to help you more intelligently determine the income portion of the portfolio, it's important to know what vehicles are out there in order to generate income. And we're told our entire lives to, work hard, save diligently, invest in your 401k, 403b, IRA, whatever it is. Because eventually, why are we doing all that? Because we're going to need that eventually to live off of in retirement. But then we all come to retirement, and I've seen so many retirees who now have no idea how they're going to generate an income stream from those assets. It might just be as simple as, well, you've been putting money in, let's just start taking money out. That really doesn't work too well. And they're told to save and invest their assets in order to use them for income, but they're never told how to actually go about using them for income. And to me, that's a disconnect. This industry talks about return on investment, and you can get this percentage, that percentage of growth, but how does that translate into income when you retire 20, 30 years later? So let's look at three entities that you can choose from in order to generate income in retirement. And like I said, Wall Street's way, the bank's way, and the insurance company's way. So let's assume that a couple needs to generate about $40,000 a year of supplemental retirement income from their assets. So that's over and above whatever Social Security is giving them. That's over and above whatever, if they have any pensions, it's more than what that's giving them. This is what they need to pull out of just their assets. How are they going to do that using each one of these entities? Well, let's start with the bank's way. Oh gosh, you know what? I wish that we had the interest rates that used to be paid back in like the 70s. If somebody only needs, if you've heard of the 4% withdrawal rate, that means if you take 4% out of your assets for income in retirement with a proper stock bond split, this actually happened back in the 90s when this 4% rule came up, then you should have a pretty good high level of confidence that your assets are going to last your entire life. Well, gosh, CD rates were paying more than that back then, so you could just put all your money in the CDs, not have to worry at all. Every time they came due, just roll them over, keep getting those high rates, and your income is done. There wasn't really a whole lot of planning that went into this. And then all of a sudden, like the 80s and 90s hit, and then the stock market shooting up. You fired your advisor if you weren't averaging around 15%. And so Wall Street ended up being the place to put your money during that time. Well, then we got the 2000s, and even I would arguably say even 2000s from 2010 until now. Even if you look at what the stock market's done during that time, Wall Street really wasn't the place, and neither were CDs. And so let's go through this. Let's do some math here. The days, obviously, I mentioned they're gone of those high interest earning CDs. They're paying such low rates now. I even had a client say they coined the phrase "point nothing." They're paying point nothing, and I've used that in a lot of my seminars. And at the time that I wrote my book, 1 year CDs were on the low side. We're paying about 0.75%. On the high side, we're paying about 1.25%. 2-year jumbo CDs were paying 1.5%. A 5-year jumbo CD, which means that you have to at least have $100,000 or more invested in it, was paying 1.1 to like 2.25. I think I've seen some as high as about 2.5 now, maybe even 2.75. So let's use, I guess, 2.25. That 5-year jumbo CD for the example here, and that means for a couple to generate $40,000 from the interest earned on that CD, they're going to need $1,777,000. Excuse me, let me say that again. $1,777,777.78 in that CD. Oh, so if that's their total nest egg, they've now got no money for emergencies, no money for the what ifs that might come up, no extra money for discretionary spending or vacations. It's all going towards that $40,000 of income, and then most likely not keeping up with inflation either. Now, to be fair, they're only taking out the interest as income, so they would still have that $1.77 million in the bank, and they still have access to it. So upon death, that $1.77 million would pass on to their beneficiaries, but they're sacrificing a lot of growth potential for a competitively low return. So the next question is, well, if we're needing a little bit more growth, well, let's look at Wall Street. Let's look at the market. As of this recording, the market had been going straight up. I mean, we'd been in the longest bull market in history up until the end of 2018. All of a sudden, we did hit back into bear market territory with the S&P, Dow Jones, NASDAQ. They went down 20% from their original high. Now, if you look at the S&P, it was really only down for the year about 7.5%, which, I mean, it's not horrible, but it's still more than what a lot of my clients would like. And with the Wall Street way here, since we're taking a look at this, you got to understand this is definitely not a safe rate. It's not a guaranteed withdrawal rate because the value of the investments can go up or down with market losses, excuse me. It does offer the greatest potential for growth in the up years. However, that's definitely a benefit to consider, but someone using this choice for an income stream has to understand that their income could fluctuate quite a bit since it does go up and down. And this category can include dividends or interest in addition to the pure growth, but even those aren't guaranteed. And let's just go back to that commonly accepted withdrawal rate to be used, 4%. And once again, I mentioned that 4% rule happened back in the 1990s. That was when that was actually, that came about. And like I said, stock market was going up. We weren't seeing near the volatility we were today. And now you could actually Google this. There's several different articles you can Google now on like safe withdrawal rates. And they're going to tell you that 4% has actually moved down to about 2.8%. So less than 3. So using that 2.8% rate of return, that hypothetical couple now needing that same $40,000 a year to generate income, they'll need $1,428,571.43 in order to do that. So if they average at least 2.8%, took out only the 2.8, our couple will still have that full amount of the initial investment left when they pass on, and it'll pass to their beneficiaries. However, if this is the only place they have their assets that they're going to use for income, what's their plan during the years when the market goes down? So now when it goes down, they're not taking out just 2.8% of their portfolio. That the percentage has gone up because now there's less money in there. And so that, in which if you've listened to some of my other podcasts where we're talking about reverse dollar cost averaging or sequence of return risk and all of that goes on, because that 2.8%, that's not a straight shot. It's not averaging that every single year. Some years it's going to average more. Some years it's going to average far less. So that's the issue when it comes to getting income from Wall Street's way. So let's move on to the insurance company's way. Now, insurance, we're going to focus mainly on annuities with this example. I mean, you could do cash value life insurance taken out as policy loans. If you structure the policy correct, we're going to have more podcasts on that later. You usually need to start that a lot earlier in your retirement career or during the accumulation years for that to be really effective. When a lot of the clients that come to me, they're really close to retirement or already in retirement. And so that doesn't end up being a good strategy for them. So we're going to focus more on this case with annuities. And there's a lot of different kinds of annuities. And of these different ways to generate income, insurance companies are actually the only ones that can guarantee an income stream for your entire life or for your spouse's entire lives if you choose to set it up that way. Insurance products like annuities are backed by the financial strength and claims paying ability of the issuing insurance company. And I'm going to have a later podcast that focuses solely on the safety of insurance companies versus the safety of banks, because I do also have a background in the banking industry where I worked for a company that actually audited banks, and we would come in before the actual state regulators would come in, so we could tell the bank where they were deficient so they could fix it before the actual state regulators came in. So we were a third-party auditing company, and that was kind of around the 2008 timeframe. So I kind of got a peek behind the true nature of banks and what FDIC insurance really means. So I'll get more to that. And to give you a bottom line, I actually believe the insurance companies are safer than banks as far as where to put your money. So I do think this is important to repeat. The fact that they are not one of many choices that can guarantee an income stream for your entire life. They are the only place that can guarantee your income for your entire life. CDs cannot do that. Neither can stocks, bonds, mutual funds, or anything else in that arena, what you normally think of when you invest into the market. So by pooling risk, a lot of the same way that life insurance itself works, they're generally able to offer a higher percentage payout on your money as well. So for example, a 65-year-old might be getting a 4.5% or a 5% payout on their money, depending on if he or she chose a single or a joint payout. Might be higher, might be lower, depends on the products whenever you look at them, which is always important to have someone who knows what all the products are and has access to all of them, so they're not a captive agent. They actually have access to everything out there so that they can find the best payout for you. Now, depending on the type of annuity that you select, although there are other strings attached to get these higher payouts, you should be able to get 5.5 to 6. And remember, that amount, whatever that amount is, that payout amount, that is going to be paid for your entire life. That's now guaranteed, subject to the claims paying ability of the issuing company. I happen to have that disclosure on there because, like I said, they're safer in my opinion than even banks. So let's just use the smallest percentage that I said, 4.5%. In order to see what we would need to generate that same $40,000. We would need $888,888.89. So that's basically 38% less than Wall Street's way and 50% less than the bank's way. If we're being fair, though, I use the highest percentage of the other two. So if we use the highest percentage for what I said for the annuity payouts here, using only 6%. Depending on your age, it could be even higher than that, but let's just use 6% here. That would be only $666,666.67 that would be needed. So if we go back to like the total nest egg, if it was actually 1.7 million, think of how much extra now you have to do everything else. If you can just set this aside to know that your income throughout retirement is absolutely, completely guaranteed, and you have over another $1 million left in your portfolio to do whatever the heck you wanted to do with it, as far as like your bucket list items, travel, anything else, you can rest in the knowledge that you can do all those extra fun things with all this other extra money and never, ever have that impact your future income. That's powerful because that means that gives you confidence in spending in retirement. And that's the whole reason that we save all this money anyway for retirement. It's not just to sit it in a bank or sit it in a brokerage account and never actually use it. It's there so that we can actually do the things that we want to do and create a quality of life. Not just a living, a quality of life in retirement. Hey, podcast fans. If you're ready to take the next step towards securing the confident retirement you've always wanted, then stop by retirementrescueradio.com. You have 3 options to get started. If you want to stay on top of current retirement trends or other fun retirement topics, you can sign up for my News You Can Use email newsletter, where I offer up updates on the market, trending articles on retirement from professionals in the field, or just fun things that can make your retirement more fulfilling. I'll send it directly to your inbox every single Monday. Or maybe you'd like to attend one of our complimentary, no-obligation informational retirement planning events that we have coming up. We have several opportunities listed on our company website at www.millerretirementgroup.com/seminars. Again, that's millerretirementgroup.com/seminars. And finally, if you have specific questions you'd like to get professional guidance on right away, you can sign up for a complimentary consultation. It's totally up to you. Again, that's retirementrescueradio.com. retirementrescueradio.com. Now, back to the podcast. Now, I have to have this in there for compliance reasons. So something to think about is if the internal growth rate of the annuity does not keep up with the amount that you're withdrawing, it will decrease the contract value and the value of any of the protection benefits. If it's depleted completely, the issuing company is still This is what's amazing. If you completely blow through all the money that you invested, the issuing company is still contractually obligated to pay that income to you and your spouse. If you pass away, they still have to pay it to your spouse. But there may not be any death benefit left over for your beneficiaries if you blow through the entire account value. So that's the good and the bad. Really, it means if you completely run out of the money that you invested, they still have to pay the income to you, although there may not be a death benefit for any of your beneficiaries. But you know what? That's not why you get it. The death benefit in this example would just come from any funds left over, if any, that did not get distributed to you in income. And that's also important to realize is when people think of annuities, a lot of them are thinking to themselves, well, if I hand over money to an insurance company and get an income stream, well, then I just gave up access to all my principal. It's gone. And if I die, next year, then the insurance company keeps it all. That's the way it used to work. It doesn't work that way for specific types of annuities. Matter of fact, I will have a podcast where I go through what, in my opinion, is the 5 different types of annuities that are out there, and I will explain that in depth. That's not how they work anymore, or at least it's not how the majority of annuities out there work anymore. So you can probably see why the insurance company's way to help take care of income needs in retirement can be an effective strategy if we find that it does fit someone's needs. However, each way of generating income does have its own merits, and we still have the responsibility to do what's in the best interests first. So for some, it really makes sense. For others, it may not. I'm only concerned with what works best for the individual situation and what works best for the goals that they have in mind. And I don't get mad at screwdrivers because they do a horrible job at hammering in nails. If someone is looking to accomplish something, we're going to look for the financial tool that does that in the best way possible. So basically what we're looking for, we're actually looking for the smallest amount of your assets that will be needed to generate the income that you need to generate in retirement. That way, all the rest of your assets can be free to do whatever the heck you want to do with them. What's also interesting about that concept, though, is let's say you have a certain amount that you want for income, or at least that's like needed. We call those your paychecks in retirement. But let's say you want a little bit more every single month because you've got other things that you want to do, go out to eat quite a bit, or just, put some money into an account to save up for a couple vacations that you want to take every single year. You can even set it up to where you have a higher monthly income if that were what you want to do. So then that now, in order to, in addition to just having paychecks, you've also got play checks. You have income over and above what your needs are. And once again, going back to the confidence in retirement, when you have more income coming in than what you actually need, what your base expenses are, well, then anything over and above those base expenses now becomes quality of life. And depending on what you want to do, you can increase or decrease that quality of life based off of how much income you actually want to have coming in. So once we've at least solved for how much do you need bare minimum, well, then you can decide if you want to do that and just put the rest of it into market-based investments for a little bit of that and that extra cushion or the bucket list, or if you actually want a higher monthly income, well, then we just adjust what goes where. It's all about somebody's individual plan. And hopefully I'm not making that sound like too simple, but honestly, when it comes to retirement planning, we do want to make sure that things are as simple as just understanding what you want to accomplish, where your income's going to come from, and how long it's going to last. And now, hopefully, going through this, you have a little bit better of an idea of what places now in today's landscape are better for generating income than what they used to be. And what I see a lot of times, though, is if someone is used to a certain thing, then it's hard for them to transition their thought process over to a new way of thinking. And that's normally what has to happen, because if we've been told our entire life that you need to have your money in the market, that may have been true for that phase of the financial life. But when we start refocusing our wants and needs to be income focused rather than growth focused, well, now it takes a little bit different mindset or a different focus and honestly, different financial products to accomplish that. So once again, to summarize, when it comes to generating an income stream in retirement, it is, if you want that income stream to be predictable and consistent, you are actually able to get a higher payout on your money or a higher percentage rate on a guaranteed basis utilizing insurance type products. Now, we want the proper blend between insurance versus what you've got in the bank versus what you've got at risk in the market. And we understand that blend. We don't want all your eggs in one basket. So we're looking for the least, at least bare minimum, the least amount that you need in order to generate the income that you need, and then we can adjust going forward from there. Oh, and before we go, I do have to touch on this as well. When it does come time to start thinking about where you want to put your money, I know a lot of people that will just Google something. And oh my gosh, I give you a little bit of not only the background when I was consulting financial advisors, but also kind of where I'm at right now. See, I play in the insurance world. I play in the Wall Street's world. So it's like, I play in those worlds. It's like I understand what they're used for, what they're good for, what they're not good for. And so it's just all about, once again, finding what's right for your particular situation. But I want you to understand this. I used to consult guys that were insurance only, right? So that means that they really only sold life insurance or annuities. And so, by gosh, if you asked them what or where the best place was to put your money, what do you think they said? Well, they'd say insurance. They'd say annuities, life insurance, stuff like that. Exactly, right? Well, then on the other end of the spectrum, you've got the advisors that are not insurance licensed at all. They are only playing in the securities world. They're either fee only or asset based, whatever. And that's all they pay. And so guess what? When there's from their vantage point, insurance is the devil, and securities is the answer to everything. Put all your money in stocks, bonds, mutual funds, and hope the market goes up every year. So that's kind of where that goes. And being licensed in both areas, the market-based investments and insurance-based investments as well, it's like, you know what? We don't think either one of those is the correct answer. And if you look online at all these different vantage points, where if somebody is saying this is bad or that is bad, or don't put your money here or don't put your money there, if you follow the money, meaning if you actually dig in on why they're actually coming from that standpoint, you'll find out it's because they don't offer those investments. They don't offer those. And so I want you to understand that as you're looking and reading through information, I want you to think, what is this person's motivation for writing this particular article? Is it because they want to be fair and balanced, or is it because they've got a dog in the fight? They have some monetary reason on why they're writing that article and skewing things that way. So I'll tell you what, guys, if interest rates on CDs end up going up to like 6, 7, 8% again, and fixed index annuities aren't anywhere close to that, and the market's tanking or whatever, it's like, hey, shoot, I'll go back and I'll recommend that you put money in CDs if you're trying to generate an income. Because that'll work, and it'll do it safe, it'll do it predictable. That'll be great. Whatever the landscape is, that's what we're going to recommend. Right now, honestly, it's looking like if you want to generate an income stream, insurance companies are doing a better job of that. And I'll be having a lot of people on the show going forward, like in the future, industry experts that are actually going to be talking about different ways to generate income and all of that. So definitely stay tuned to all that. But hopefully right now you guys are starting to understand why, and I'm giving a fair and balanced approach of all of the different options that are out there, so that you can actually make a more intelligent decision when it does come time for you to be thinking about retirement, and then who you would use for your advisor. So once again, I hope you enjoyed this. This is the second installment. That wraps up the second installment of the series on annuities, cutting through the crap. Thanks for joining us here at Retirement Rescue Radio, and keep on listening. Thanks for listening to this episode of Retirement Rescue Radio. To learn more about how we can help and to get access to today's show notes and the resources mentioned, visit retirementrescueradio.com. Again, that's retirementrescueradio.com. Also, if you liked what you heard, please consider hitting the share button and share this podcast with a friend. The more people that share this podcast, the more people we will reach. If you found this information helpful, you can bet that there are many more people that need to find us. It's up to you to help. Also, if you have any questions that you would like to have answered on the show, or ideas for show topics, or even ideas for guests that you would like to hear on the show, simply drop us an email at asknate@retirementrescueradio.com. Again, that's asknate@retirementrescueradio.com. Thanks again for taking the time to listen, and be sure to tune in next time for another episode of Retirement Rescue Radio.